So this is the analysis for the USD JPY trade I took this week. This is how I came about that trade. So first of all, according to what I already say, first go to the 4-hour and identify your market structure. As you can see here, we're first in a downtrend. You can see higher, lower high, lower low, lower high, lower low. The lower low went, then we created by a retracement. Yes, you can see is the last lower high. So this place broke the last lower high. You can see here broke the last lower high, making here a market shift. So I'll go again, lower high, lower low, lower high, lower low. Then market went to the lower high, the previous lower high, and was about retracing or going down to create another lower low until it pushed up, causing a market shift, or what you call change of character. This now has changed the market from a bearish market to a bullish market. So after you mark that out, first thing you do when the market starts retracing is to mark your 4-hour swing high and 4-hour swing low. So you can see this is a 4-hour swing high and here is a 4-hour swing low. Now in this market, we have a flip zone. What is a flip zone? A flip zone is a zone that causes other zone to fail. In this case, this flip zone caused this supply zone to fail. Because this supply zone here was to work, the market is supposed to push down and create another lower low. But the market didn't. The market went up and break through the last lower high, creating a change in character. So that's a flip zone. I will do other videos about flip zone, explain in detail how to spot them. But for now, I'll just take that. That's a flip zone. So immediately you have marked your swing high, swing low, you know your market structure now in the 4-hour. You then go down to the 1-hour to restructure your demand zone, your flip zone, or that zone. So you go one straight to the 1-hour. On this case, I did not restructure this flip zone because the flip zone was an area. It was not specific. There was no specific pivot candle that I could reduce the flip zone to. So I left it that way. So immediately I observed that the flip zone was not being able to be shrinked. I left it and went straight to the 15 minutes. I only go to 15 minutes when the market has interacted with the zone that I have marked out. So I don't look at my chart 24 hours a day, 500 hours a year. I just set my flip zone, my demand zone, supply zone, or any zone at all. Set my alarm at the entrance of the zone, like this part here. Then I go do anything I want to do. So immediately the market enter into this flip zone, I go straight to the 15 minutes. This is a 15 minutes. This is where the market enter into the flip zone. So what are we looking for in 15 minutes? We are looking for a change in character. So first of all, immediately you go into the 15 minutes, you first understand the market structure in 15 minutes. And in this case, the downtrend. You can see it's a downtrend here. Lower high, lower low, lower high, lower low, lower high, lower, about to create a lower low, but it didn't. The market shift happened. The market broke through the last lower high or higher low, I mean to say. It broke through it, and that is what we are looking for, a market shift. So all you do is mark out a market shift or change in character, any way you call it, 15-minute market shift. So now all you have to do next is look for the candle that initiated the break to the upside, initiated the market shift, and that candle is this candle here. That candle is this candle right here. So you mark it out as your demand zone. That is your demand zone. But unfortunately, the market did not go to that demand zone. It did not go there. So I waited. What was I waiting for? I waited for another higher high to be formed. And where did that happen? Another higher high happened around here. You can see this was the last high before this was the last higher high. The market retraced down and created another higher high. So now this is the last higher high. So I set my demand zone on this higher high here, this candle here. I set my demand zone on this candle because this candle is a candle that pushed this face to create an higher high, a new higher high. So what I did was to wait for the candle or the market to go straight to that demand zone. So I set my buy limit there. I did the same thing for this place too. Set my buy limit down there, but the market did not go there. So I look for the next higher high to target and set my buy limit here. And it made the market fall to my buy limit, tap into it, and it went up. That was my first trade. That was a 1-to-5 risk ratio. So my next trade was the next day. So the market formed an higher high, went down a little bit, and went up, creating another higher high, higher low, then higher high. I observed this candle. This candle had a lot of momentum. So it showed that the buyer, all the smart markets, or anything you want to call them, entered into the market at that time with full volume. So I marked out a demand zone right here, then set my buy limit. The market was on top, was here. The market was here when I still set my buy limit here. So market fell down, tapped into my buy limit order, then went up. The market was very in my favor. So this was what made me take the trade. This is how I took the trade, and this is how I trade. So you can learn from this. But this method, everything, Forex trading as a whole, requires patience. Patience. So after learning this strategy, you have to be patient. Sometimes the market don't retrace. Market just go. You leave that market. The market does not retrace and just go straight without retracing. Leave the market. That's not for you. You only trade when the market retrace back to the demand zone. Back to your demand zone. Do not trade when the market does not. Do not trade mid-air. If not, you will lose. Thank you very much. You might have even win too. So this trading, but you will not have an edge to refine if you keep taking trade randomly. This is why you always have to take trade that meet your criteria.